In the final days of July 2026, while preparing for his wedding in Carmel, California, Leopold Aschenbrenner watched an investment operation once described as a $45 billion powerhouse rapidly unravel. 2 years earlier, he'd written a manifesto so widely read in Silicon Valley that people quoted it like scripture. He'd been a prodigy, valedictorian at 19, a researcher at OpenAI, a man who seemed to see the future of artificial intelligence more clearly than almost anyone alive. Then he'd built a hedge fund around that vision, and for a while, the vision paid off spectacularly.
We're back with Morning Trade Live. Let's focus on the tech story of 2026. That's the memory stock rally. Check out what's sad.
And by the way, I'm just noticing the S&P here has rolled over. We're almost back to the lows of the day.
And the question that started circulating in trading discords and finance Twitter threads wasn't just what happened. It was, did someone make this happen faster than it should have? But to understand why so many people asked it, you have to understand exactly how much pressure one person can be under before a fund like this breaks. Situational awareness wasn't a cautious fund. It ran on leverage, reportedly as much as 400%, meaning for every dollar of investor capital, Aschenbrenner controlled $4 of exposure to AI infrastructure stocks, semiconductor makers, memory chip producers, data center plays. Leverage is a multiplier. It doesn't just double your gains, it doubles your losses. And it does both faster than you can react. In the first half of 2026, that leverage produced a 439% return. Aschenbrenner became, briefly, one of the most closely watched investors on Wall Street. Investors sent him more money. 6 days before the collapse, he was reportedly still telling clients to add to their positions. Leverage has a second feature, though, one that matters more than the multiplier. It runs on other people's clocks. When you borrow to invest, your lenders, in this case prime brokers like Goldman Sachs, Bank of America, and JP Morgan, get to decide how much time you have to be right. If the value of your collateral drops, they don't wait for your long-term thesis to play out. They call. And when they call, you either bring cash or you sell. That's the mechanism. Now picture living inside it. Imagine the span of about 72 hours. Monday, AI infrastructure stocks are sliding. Chip names, memory names, the whole sector catching a chill from rate hike anxiety moving through the market. Your fund's collateral is worth less than it was Friday. Tuesday, the losses compound. Your short positions, bets that certain software stocks would fall, are moving against you too, in the wrong direction, at the wrong time. Your prime brokers are calling. Not once, repeatedly. They want to know your plan. Late Tuesday night, your team scrambles to find a buyer for part of your private portfolio, a multi-billion-dollar stake in a company you believe in for the long term, just to raise cash fast enough to satisfy the margin calls. A deal is reportedly reached with outside investors to sell a slice of that stake. Wednesday morning, the deal falls apart. Something better, or worse, has appeared, a much larger buyer, a hedge fund with the balance sheet to absorb your entire public equities book in one transaction. Millennium looks at it. Jane Street looks at it. Both pass. One firm doesn't. Citadel, run by Ken Griffin, one of the largest and best capitalized hedge funds on earth. By Wednesday night, in under 24 hours, $16 billion of stock has changed hands. Your fund, 3 days ago worth $45 billion, is worth roughly 10. Now here's where the story splits into fact and speculation. Just before the worst of the sell-off, Citadel Securities made a public call. A surprise Federal Reserve rate hike was coming. Not a rumor, an on-the-record forecast from a Ken Griffin-owned firm. Historically, that kind of signal can spook markets into exactly the sell-off that follows. And the timing raised eyebrows, because it wasn't just any Griffin firm making the call. The market maker that published the note and the hedge fund that would soon buy the wreckage are legally separate businesses. Days later, the sell-off hit. Situational awareness's collateral cratered. The margin calls came, and Citadel, the hedge fund, was waiting on the other side, ready to buy the wreckage at a steep discount. In reality, the rumors that the Fed would raise rates, a lie. The Fed did not actually raise rates that week. So we're left with two things that can both be true at once. A young investor really was crushed by leverage, of his own choosing, under real margin calls, on a real clock he didn't control. And somebody may have tightened that clock on purpose. Whichever version is closer to true, Consider what it would feel like to be the person inside it. You built something the world called visionary. You raised billions on the strength of being right about the future. And then, in the space of 1 week, every lender who ever trusted you started calling at once. Not because your long-term thesis was wrong, but because your financing window closed faster than your investment horizon could survive. You tried to sell a piece of your best asset just to buy time. That deal collapsed. A bigger, faster buyer appeared instead, offering you a way out that also happened to hand your rival the upside on everything you believed in. Maybe the market didn't just turn against you. Maybe it was turned against you. You don't get to know, in the moment, which version is happening. You just get the margin calls. You just get the clock. Whether the pressure came from an impersonal market or from something more deliberate, the man living through it experienced the same thing either way. The sensation of watching something he built at incredible speed get taken from him at an even faster one, with no way to tell from the inside whether the storm was natural or made. That uncertainty, not knowing whether you're facing bad luck or a deliberate hand, may be its own particular kind of pressure. Maybe the heaviest kind there is. If you like this video and want to see more, make sure to like and subscribe. Let me know what you think in the comments. Did Citadel take advantage of their power? Or is this all fair game in the markets? Your opinion will help shape the markets of tomorrow.